some differences between trading in commodities compared to other financial assets. When we talk about trading in markets, we often think of stocks, bonds or other financial instruments. However, commodity trading is fundamentally different from trading in traditional financial assets. Let's understand how commodity trading differs from trading in stocks and bonds and why these differences matter so much in real-world markets. First, nature of the asset. The first and most important difference is what is being traded. Commodities are physical assets. Examples include wheat, crude oil, gold or cotton. They represent claims on real tangible goods. In contrast, stocks and bonds are financial promises. They represent ownership or debt claims on companies or governments, not physical goods. This physical nature of commodities makes their trading, settlement and storage very different from financial assets. 2. Seasonality in commodities. So another major difference is seasonality. Many commodities, specifically agricultural commodities, have strong seasonal patterns. For example, crops are harvested only during certain months, supply increases after harvest and reduces before the next season. This seasonality must be carefully considered while trading in commodities. On the other hand, financial assets like stocks and bonds do not have such extreme seasonality. They can be issued and traded throughout the year without any such supply cycles. Third, price determination. Financial asset prices depend heavily on the financial strength and credibility of the issuer. Interest rates, risk premiums. For example, a company's stock price depends on profits, balance sheet strength, growth prospects. Commodity prices, however, are driven mainly by supply and demand conditions, weather, production levels, global consumption trends. So while financial asset prices are issuer-centric, commodity prices are market-centric.